All right, good morning, everybody. So we got some questions about nonprofits and how they deal with sales tax. So we brought on somebody who knows a lot more than we do. So here today with us is Mitchell Robbins from the Department of Revenue. He's going to cover just some sales and use tax information for nonprofits, and then as you guys have questions, kind of jot them down, and at the end you'll be able to ask questions, and maybe we can get everything answered for everybody. All right.
Okay, I'll jump right in. Good morning. As Tommy said, my name is Mitch Robbins. I'm a manager in legal affairs and tax policy at the Georgia Department of Revenue, and I'm over a sales tax group. In short, what my group does is we issue letter rulings to taxpayers that write in for binding advice. We hold conferences for taxpayers that get a proposed assessment and want to have a conference with the Department of Revenue, and then we issue a ruling in response or as a result of that conference. We draft the sales tax regulations for Georgia. We put out bulletins, answer questions, meet with industry groups, and just try to keep the Department of Revenue on course and doing the right thing in the world of sales tax. So this slide just shows a brief outline of the categories that I'm going to run through, and we'll start with sales and use tax basics. And when I put this presentation together, I didn't know what people know and what they don't know, and so I hope some of this helps. I'm used to speaking to people that are live in front of me, and they can tell me just skip and move to another slide. We know this, we don't know this, but this being set up the way it is, I'll just run through everything that I have in here. Sales tax, as many people probably know, is a transaction tax. It's imposed on retail sales. Retail sales does not include sales for resale. So, for example, a traditional brick and mortar or even online retailer buys all of their inventory for resale. That means they don't pay tax on it. And when they sell it at retail to the end user, sales tax is due. And it applies to tangible personal property and a few services. Tangible personal property includes, it's not real property. It is items that you can see and feel and sense with your senses. Use tax is a little bit more confusing, I think, than sales tax. The phrasing that you hear is that it's a complement to sales tax. The goal is to pick up use tax on the purchase of items when sales tax has not been previously paid. And that's a little bit of a generalization, but that's the underlying starting point. Some common use tax transactions are if you order something over the phone or by catalog or perhaps online from a seller that does not collect Georgia sales tax, use tax is then due. And the bottom bullet point where it says use tax does not duplicate sales tax simply means you pay one or the other. If you pay sales tax, as a general rule, you don't owe use tax. And if you pay sales tax to a particular state and it's paid legally, and then you take the property to another state, you technically owe use tax in the second state, but you would get a credit for the sales tax that you previously paid. And so again, that illustrates how the use tax doesn't duplicate sales tax. You get a credit for sales tax that was properly paid. The rate is the same. If you purchase something in DeKalb County, for example, you would owe the DeKalb County sales tax. If you were a resident of DeKalb County and you order goods and you have them shipped to you and you receive them in DeKalb County, you owe use tax at that same rate. And as I mentioned, you do get reciprocal credit for sales tax that was legally paid first to another state or another county. You do not get credit for taxes paid to another country. Again, the sales tax and use tax, as a general rule, is imposed on tangible personal property. There are a few services that are included in the definition of retail sale. Generally, these are utilities, electricity, gas. One that's not a utility, transportation services are subject to tax. Hotel accommodations are subject to tax. charges to participate in games and amusement activities are subject to tax, and admission charges are taxable when it's an admission for a entertainment type event or a place that has exhibits such as a museum. Sale is any transfer or title of tangible personal property. And as I mentioned before, more specifically for sales tax, it's retail sales that are subject to tax. Here's the definition of tangible personal property. I think I mentioned that a minute ago. And you can see that it includes electricity, water, gas, steam, some common transactions that I call utilities. So I'm not sure if most people consider those services or tangible personal property, but either way, they're subject to tax. Stocks, bonds, notes, and insurance would all fall under intangible property. And then real estate is, of course, real property. So those items listed in the third bullet point are not tangible personal property, and they don't fall within the scope of what's subject to sales tax. Again, here's a few of the services that are taxed. You can see participation in games and amusement activities at the bottom. That would be, for example, a charge to play in a golf tournament. The one above that, admissions, would be a ticket to a Falcons game, would be an example of that. Accommodations includes hotel accommodations and other accommodations that are generally furnished to people on a short-term basis. Transportation, such as cabs, limo rides, and then again, utilities that I already mentioned. It's a dual responsibility tax, and what that means is that both the selling dealer and the purchaser are liable for the tax. So if a seller sells an item and does not collect tax and does not obtain some type of exemption documentation from the purchaser, Georgia law makes that seller legally liable for the tax. So the Department of Revenue can go after the purchaser that bought the item or the seller that sold the item. And as a matter of convenience, the way it plays out is the department, I think, generally goes after the seller simply because one seller may have thousands of customers, and it's not administratively possible to go after thousands of customers for each of their purchases. The definition of dealer is in 48-8-2 of the Georgia Code, and I'm not going to go through each part of this, but generally, our definition of dealer equates to what a lot of states call doing business in the state, or nexus. Nexus is the term to describe if someone has a taxable presence in the state. So if someone has a store in Georgia, we would say they have nexus in Georgia. They have a taxable presence in Georgia. Again, sometimes you'll see this defined, depending on the state or the type of tax, as doing business. You're doing business in Georgia. For sales tax purposes, Georgia uses the term dealer. So if you meet the definition of dealer, we would say you have nexus in Georgia, you're doing business in Georgia for sales tax purposes, and we would expect you to comply with the filing requirements and tax collection requirements. And it's a long definition.
And we'll make this presentation available along with in YouTube. So that way people who want to take time and read through this can
sure.
do that.
And at the end of this, there's a slide in the presentation that will point you to what I think is an easy way to find the Georgia Code and the regulations that you would need to look up sales tax issues. On this definition of dealer, one aspect of it I will point out, Georgia put in a provision, I think it was about 3 or 4 years ago, that some people refer to as click-through nexus. It's not limited to click-through nexus, but what it was meant to capture was out-of-state sellers selling goods into Georgia when those out-of-state sellers get sales referred to them by people or businesses in Georgia, and the out-of-state seller pays some form of commission for those referrals. And so I'm not going to name any particular companies, but anyone that shopped online has probably dealt with that type of transaction. You may start at one website, click through to another website, And if that second website is out of state, but they get enough referral business from within the state, they become a dealer, and we would expect them to collect Georgia sales tax on the transactions. Once someone is a dealer, we expect them to register. Once registered, again, we expect you to comply with the filing requirements and the tax collection requirements. As a general rule, I believe the department expects someone to file at least 6 monthly sales tax returns after they register, and then depending on the volume of their sales, they may qualify for a quarterly filing or annual filing, but everyone is set up initially as a monthly filer. The form is ST3. Currently, almost all dealers are required to file and pay electronically. I think there's some dollar thresholds that trigger this requirement. I don't know the threshold off the top of my head, but it's not a very high threshold. So we find that most dealers are filing and paying electronically these days. And as I mentioned, you can see in the third bullet point that dealers are initially set up as monthly filers. Returns are due on the 20th day of the month following the month that's being reported. For people that file on a quarterly basis, it would be due, the return would be due the 20th day of the month following the quarter that's being reported. When we talk about the sales tax rate, sometimes you'll hear people use the word sourcing, and the context here is to what local jurisdiction is the sale sourced. And as a general rule, the sale is sourced to where the customer takes receipt of the item. And so I put the statutory site up there, 48-8-77, and there are some exceptions. But again, the general rule is where does the customer take receipt or delivery of the item. So if the customer is in a brick and mortar store and walks out with the item, the local sales tax rate would just be the local rate in effect at that particular location in the county where that brick and mortar store is located. The state rate is 4%. The local rate varies. I think these days it varies from 2% to as high as 4.9%. Service providers in Georgia, as a general rule, don't have to register and get a sales tax account. The reason I say as a general rule is because you will get different answers on that from the department. I think technically the law requires anyone who's a dealer to register. And in that long definition of dealer, there's an emphasis on people selling tangible personal property, but there's also some language in there that's very broad and seems to capture virtually anybody doing anything in the state, including service providers. So I think there is a reading of that statute that says service providers have to register, although, like I said, it's an area where you may get different responses from the department. If the service provider does register, again, we expect them to file returns, and they would be set up like everyone else as a monthly filer. As a service provider, they are probably not making taxable sales, and they would qualify for quarterly or annual filing. The key for service providers in the world of sales tax is that they owe sales tax or use tax on everything that they buy. So even if the service is taxable, and I list a couple of examples here, such as accommodations or transportation, the service provider still owes tax on their purchases. So a cab driver is supposed to charge you tax on the transportation service, but that cab driver still owes tax on whatever he or she purchases to carry out that service. And a hotel should charge you tax on your hotel stay, but the hotel also owes tax on everything they buy to provide that accommodation service. I mentioned at the very beginning that the tax is imposed on retail sales. Retail sales do not include purchases for resale. And the way you would make a purchase for resale is by providing Form ST-5. That form is it's both an exemption certificate in that it can be used by entities that qualify for certain exemptions, and it is a resale certificate. And if you are buying for resale, you would check the line that says you're buying for resale. If you're using that form to take advantage of one of the exemptions, you would check the particular box that is next to your exemption.
So I have a question on that real quick. So if you're a nonprofit organization and you are purchasing items that you may resell, say at an event or a festival or something like that, you would need to have this
Yes,
possibly.
yes. As a general rule, it gets a little messy because some nonprofits, well, very few, but actually have an exemption for purchases. And the reason I'm mentioning that is its own exemption. So I don't want to confuse that with buying for resale.
All right.
So if an entity has an exemption for its purchases, as a general rule, it would get a letter of authorization from the Department of Revenue. These days, some of the exemptions are going electronic, and certain nonprofits would have to apply online, and they would get their letter of authorization sent to them automatically, or it might be in the form of a certificate, but they would get some kind of documentation from the department explaining their exemption. So back to the purchases for resale, the ST5 is the form to use when you're buying for resale. But I don't think that should be confused with an exemption that may exist for a nonprofit. So
here's an example. Say we have a nonprofit organization that is running a welcome center or a museum of some sort, in a depot in some community, and they have items that they purchase for resale to the general public.
Yeah,
then what would they do?
Yes, the ST5 would be the applicable form because they're buying items specifically for resale.
Okay.
So regardless of whether they have an exemption for items for their own use, the ST5 is the right form when you're buying inventory items that you will resell.
Okay.
And so this is probably not a good example, but nonprofit general hospitals have an exemption for items they will use in the treatment function. But they may have some type of a gift store in the lobby of the hospital, and so those are two separate analyses. Items that they will use for the treatment function, X-ray machines and MRI machines, those can be purchased with a letter of authorization pursuant to the exemption that they have. But items that they're purchasing for resale should be purchased with an ST5. They should have a sales tax number that they use, and they should report their sales, presumably monthly, collecting tax on their sales, basically like a regular retailer. And one thing I will point out, I think there's a slide on this, as a general rule, tax-exempt entities in Georgia do not have sales tax exemptions. There are specific exemptions that the legislature put in place that apply to specific tax-exempt entities, allowing them to make purchases without paying sales tax, and at times allowing them to make sales without collecting sales tax. But the starting point is that having an IRS determination letter that you're a tax-exempt entity doesn't carry over to sales tax in Georgia.
Okay.
I think there are states that have provisions that maybe are a little more favorable to nonprofits, but in Georgia, it's really done on an exemption by exemption basis. There's no blanket exemption for nonprofits to make tax-free or tax-exempt purchases in Georgia.
They're treated just like a for-profit business.
Yes.
In that.
Yep.
Okay.
That is correct. And people are caught off guard by that sometimes, and I'll point out that that's a matter for the legislature to address. The Department of Revenue does not create exemptions. We just try to administer what's out there. Dealers that make sales are expected to charge tax on their sales or obtain documentation from their purchaser in the case of an applicable exemption. So we expect a dealer to collect tax. If the dealer doesn't collect tax, we expect them to have documentation showing why they didn't collect tax. They must maintain documents for at least 3 years. I would recommend probably more like 5 years. 3 years is the statute of limitations for the department to assess a taxpayer. And so if you're getting rid of records right at the 3-year point, it can make an audit difficult for everyone. So I would recommend going a little bit beyond the 3 years for record keeping. And as I mentioned, the dealer has the responsibility of showing why it didn't charge tax, if it didn't charge tax on a particular sale. And so listed here are some of the documentation that purchasers may provide. The ST5 that I mentioned, that has multiple exemptions on it, letter of authorization. We issue letters of authorization for various exemptions. The GATE card, which is the Georgia Agricultural Tax Exemption Card, is a program that came about, I think, about 4 or 5 years ago for the agricultural industry. When taking an exemption document from a purchaser, we do expect the seller to exercise good faith. And this is a little bit of a vague test, but what we look for is that the documentation that the purchaser provides to the seller be complete and that it makes sense, meaning that the purchaser is claiming an exemption that makes sense, that the item seems like the type of item that could fall under that exemption, that the item seems like the type of item that that particular purchaser might purchase pursuant to that exemption. And if it all makes sense, generally speaking, we would say that that seller has exercised good faith. With respect to making a sale for resale, we expect the seller to confirm that the sales tax certificate, again, the ST5, has a valid sales tax number on it. And you can look up sales tax numbers at the Department of Revenue's website. I think I have a link here on the middle point here. If you go to gtc.dor.ga.gov, I believe there's a link near the bottom to verify sales tax numbers. And so again, the context here is that a purchaser asserts that the purchaser is buying for resale and gives an ST5. The ST5 should have the purchaser sales tax number, and we expect the seller to make sure that that sales tax number is a good number. So now we'll move on to some general information that's a little more focused on the tax-exempt type of taxpayer. And again, tax-exempt here means tax-exempt for income tax purposes. Doesn't necessarily mean tax-exempt for sales tax purposes. And so that's what the first 2 bullet points say. Sales and use tax exemptions are in the official code of Georgia. I think I may have mentioned the site. If I didn't, a lot of the exemptions are in code section 48-8-3. Also, the Department of Revenue puts a document online every year that summarizes the exemptions. It's not that different than what's in the code. It summarizes the exemption and gives a little bit of information on how someone takes advantage of each particular exemption. And as I mentioned, in general, nonprofit entities are not exempt from the payment of Georgia sales and use tax on purchases that they make for their own use. The reason it specifically says is for their own use is to differentiate it from purchases for resale. And that's what I touched on before, that if you're buying for resale, that's for resale. That's its own category. But if an entity is buying for its own use, the general rule, the starting point, is that the transaction is taxable. The purchaser needs to fall under one of the specific exemptions if they want to make the purchase tax exempt.
So, for example, if a nonprofit organization in a community is buying Christmas decorations that they're going to use themselves, they would have to pay sales tax to that organization.
Correct.
Okay.
That would be a
sales tax.
Yes, that would be a purchase for their own use. Okay. Now, if they were buying Christmas decorations to resell, it's totally, some type of fundraiser,
yeah.
different transaction. They can buy that for resale, and again, we would expect them to collect tax on their sales.
Yeah. So they wouldn't have to pay the sales tax to buy it because they're going to be selling it, but on the product they're selling, they would need to charge the sales tax.
That's correct. And again, that's the model that we all see shopping at retail. If you go to the mall and buy clothes, that store bought the clothes tax-free for resale and then charged tax on their retail sale of the clothes.
Makes sense.
And they do that through use of their sales and use tax number, right?
Yes.
But I guess the problem or the question we had was most of our nonprofits don't have that because they don't do this transaction often enough.
Well, I touch on that. I think there's a slide on that. If the transactions are not very frequent, I think there are a couple of possibilities. One is they can always register and do it that way and file returns again for 6 months, hopefully then qualify for quarterly or annual filing. It's possible they would not qualify for quarterly or annual filing, so if they register, they would be on the hook for monthly returns. We also have I believe it's called a miscellaneous events sales tax return. I think historically that's been used for maybe flea markets or maybe an arts and crafts show that's held once a year,
Mm-hmm.
sort of infrequent type events maybe that are held on an irregular basis.
Yeah.
So there is still a way to handle the tax. They can use the miscellaneous events form.
Okay.
Instead of the usual ST3. So I think I have a few slides here that talk about some of these specific exemptions that are out there for nonprofit entities. And so I don't recall offhand if I've captured every exemption in this presentation, but they're a little bit random. Even the order in here doesn't necessarily mean anything. So as you can see, the first bullet point, nonprofit licensed nursing homes, licensed inpatient hospices and general hospitals. And then again, these are talking about nonprofit licensed general hospitals, mental hospitals. There's a sales tax exemption for them to make purchases that they use in the treatment function. I think the department is generally pretty good about how we interpret treatment function. I don't know that they would get an exemption literally for everything they buy that goes in the hospital, but I think it would be a large amount of what they buy, a high percentage of what they buy in the hospital would probably qualify. And that reminds me of one other point that I will make. As a matter of statutory construction and how we interpret the exemptions, exemptions are always, this is in Georgia and any other state, are always construed narrowly against the taxpayer. So I mentioned that treatment function is a term that we have to interpret, and we're pretty good about interpreting it, but there are limits. Like every exemption does have limits, and most exemptions, as I mentioned, are construed narrowly. The American Red Cross does not have to pay tax on its purchases. There's an exemption for organizations that primarily provide services to intellectually disabled people. Certain licensed child caring institutions and maternity homes get an exemption. And the reason you'll see some qualifying language in the presentation about certain entities is simply because there are requirements that go with each of these. The requirements are in the statutes and regs, and I did not put all the specific requirements in this presentation. Private schools with any combination of grades 1 through 12 get an exemption for purchases that they will use in their educational service function. Food banks have an exemption for purchases of food. And I did cite to a policy bulletin here, policy bulletin SUT. SUT is a reference to sales and use tax, -2017-02. So that bulletin has a little more information on the exemption for food banks. Blood banks have an exemption. Organizations with the primary purpose of raising funds for books, materials, and programs for public libraries have an exemption. Health centers and volunteer health clinics. Again, there's a bulletin that has a little bit more information on this exemption. The Georgia State Society of the Daughters of the American Revolution have an exemption. There's a fairly new exemption for job training organizations that specialize in the retail sale of donated items. I think the way that works is that the organization has to specialize in the sale of items. So they have stores where they're selling items that are donated, but the funds that they are raising go toward their job training function. And there's a policy bulletin with more information on this exemption. Churches do not have a general sales tax exemption that applies to their purchases. And that's really just the same as the general rule that tax-exempt entities do not have a blanket exemption that applies to their purchases. However, there are some specific items that are exempt in Georgia law, and those are steeple bells and pipe organs. There was a time when Bibles and Holy Scriptures were exempt, and the exemption, I'd have to double check. I think the exemption might actually still be in the Georgia Code, but it has been ruled unconstitutional in court, so the exemption is not valid. So we're back to the general rule for sales. If the nonprofit organization makes sales of tangible personal property, the general rule is those sales are retail sales and are subject to sales tax. And that general rule that the sales are subject to tax would apply to these types of transactions. If the nonprofit accepts donations from people and then sells those items, those would be taxable sales. Sales of meals or other food, ticket sales to concerts, galas, and tours. Again, I think I mentioned in the beginning that part of the definition of retail sale are charges for admission and participation. And these are usually aimed at events or places focused on entertainment, games, amusement, activities that people would do for fun, joy, relaxation, etc. So admission to an educational course or admission to college would not be something that would be subject to sales tax, but charges to participate or be admitted to games and amusement type of activities and places are subject to tax.
So that's very important to our communities because we put on a lot of festivals. So they put on some annual festivals. A lot of them use nonprofit organizations to conduct the financial transactions.
And something I will point out, and this gets a little bit messy and it's hard to give super precise guidance, but let's say there's a transaction where the nonprofit entity receives cash and some type of item goes to the donor. The example I'll give a lot is someone donates $100 to public radio and they get a coffee mug.
Yeah.
We would not look at that as the sale of a coffee mug. And I think there are a couple reasons. One is I think general intuition tells you that there's something more going on, that nobody would pay $100 for a coffee mug. So we know that there's something else going on in the transaction. In conjunction with that, the $100 or a large part of it is probably going to be tax deductible for income tax purposes. So even though sales tax doesn't tie to income tax, we do look at what's going on in the transaction. And if the transaction entails a tax deductible donation, contribution to a nonprofit, on the whole, we're inclined to say that is something other than a sale. Now, let's say you donate $100 to public radio and you get a $3 coffee mug. You might get a receipt from public radio that says $97 of your donation is tax deductible. So then there's a question of, well, what's the last three? In practice, I don't think the department would say the last $3 is a sale of a coffee mug. The predominant nature of that transaction is simply a tax deductible donation. Nothing more, nothing less. Again, no one's going to buy a coffee mug for $100. The nonprofit entity that gives you the coffee mug would owe tax on it when it buys it. They are buying it for their own use. Their use, in this case, is as an appreciation gift. But if the transaction where that gift is given away truly is a gift transaction, then it's not a sale. And so again, we kind of look at tax deductible donations as something other than sales transactions. So, Tommy, I think you may have mentioned an example of maybe charging for an event.
Yeah.
That gets a little messier than just tangible personal property, because again, I think we can intuitively see that no one's going to buy a coffee mug for $100, but people might pay $100 for a nice dinner. And so I think what we would have to look at is the specific facts of each case and see what's going on. Is any part of that tax deductible? How much of it would be tax deductible? And unfortunately for nonprofits, as I mentioned, they don't generally have exemptions for their sales. And so even if it's a fundraising sale, and granted there are certain fundraising exemptions where fundraising sales are not subject to tax, but as a general rule, fundraising sales are subject to tax. So even if it's fundraising and the money is for their general nonprofit mission, if it's a retail sale, it's just a retail sale.
Still tax.
That falls under the general rules. And again, one of the factors we would look at to see if it's a retail sale is whether any part of the amount paid is tax deductible in the first place. And so to change the numbers, if someone donates $5,000 for a dinner, my thoughts are that it's likely some of that or a lot of that is going to be tax deductible, because I think there's a difference between someone paying $100 for a dinner. I think the $100 arguably is more commensurate with what you're receiving. $5,000 is a little high, I think, at least for government employees, for a dinner.
So back to your slide here and to where you're going. So let's say we do have a lot of membership-based organizations across the state that are nonprofits, and when you say you give them $100 for a membership, you get certain items in return. So technically, our nonprofit would have to pay sales tax on those items.
That would be my gut reaction, is that those would be items.
So you give me $100, I give you a T-shirt, a coffee mug, and a bumper sticker.
Right. I would look at that as, in all likelihood, the $100 is probably in large part tax deductible, and that those items would be subject to tax when the nonprofit purchases them.
Yeah. So when they purchase them, they would have to pay the sales tax then, and then that would take care of it.
And again, now I'm making up numbers here.
Yeah.
It gets messy if it's a $10 donation for a T-shirt, because $10 is more in line with what you would pay for a T-shirt, and so that's where I hate saying this, but in reality, it's a facts and circumstances analysis.
Yeah.
We probably have to know a little more. But I think that for that $100 membership, you receive some small items in appreciation for the membership that we would say that the nonprofit owes tax when it buys those items.
Okay. And so I got another question. I hate to keep holding you up, but you got ticket sales for concerts and different things, and ticket sales to participate in events. So we have a nonprofit. They put on an annual event, and they charge $10 to come to the event. You get a wristband, and you get to go. They would have to pay sales tax on that.
I think in that case, to me, that sounds a little more like that might not be a tax deductible donation. And I'm not an income tax expert, but I think the rule is that for it to truly be a tax deductible donation, you can't receive goods or services in exchange for it.
Not as much as on the tax donation deduction side of it, but more so on the organization that's putting on the event. They would have to pay sales tax. Say it's $10.
They would have to charge sales tax.
They have to charge it.
Yes.
If they charge it, then they'd have to remit it.
Yes. That would be my guess for that one, because I think the $10 that you're paying to be admitted to the event is probably in line with the
exchange of.
Yes, with the exchange, with what you're receiving. And so I don't know that that would be a tax-deductible donation. I think that's more like a sale. Now, it is a fundraising sale, and the proceeds very well may go toward the nonprofit mission of that entity. But the general rule is fundraising sales are taxable. Again, there are some specific exemptions.
And as long as the sales tax is paid one time, then it's covered pretty well.
Pretty much.
Yeah.
Especially the admission one is a little easier because there's really only one time when it would be.
Yeah.
So if someone pays $10 to attend an event in, say, Cobb County, I think the rate is 6% in Cobb County. Yeah. So we would look for a charge of, there are a few different ways to do it. A charge of $10 for the event, 60 cents sales tax. You can include the tax in the pricing. When that's done, we like for the seller to notify the customers, like print something on the receipt, like that the price includes tax. So in that case, it would be, I'm not sure the exact numbers, it would almost be like a $9.54 ticket and 46 cents of sales tax or something like that. So it's a total up to $10. If the entity really wants to, they can absorb the tax themselves. They are again supposed to notify the customer. So they could actually charge the customer $10 flat, just $10, and then pay the full 60 cents themselves.
But they're still responsible.
But somebody's still, on the hook for it.
But we still look for it to be taxed one way or the other.
And the reason I ask these questions, I hate to keep putting you on the, putting you on the spot here, but you're who better to put on the spot, so than the DOR. So like Chambers of Commerce, they have annual dinners. They have annual dinners. It's a ticketed event. They charge a certain amount for a ticketed event. Of course, a lot of times the business owner will write that off, but does the chamber, are they responsible for remitting the sales tax on that ticketed sale for an annual dinner?
Do you have any idea how the dollar amount?
Okay,
what type of dollar amount is paid for this?
Yeah, so let's say it's $50 a head. You know, 2 people go in, $100, or just say $50 a ticket. They range. There's a wide range of them. Some of them do them for fundraisers, and some of them do just to cover the cost of the event. So you're giving a ticket, and you're getting something in return, right? You're getting a meal or whatever. So technically, the chamber would be responsible for paying the sales tax on that. I'm guessing.
That's a tough scenario. It sounds like it could be a sale of the event, a sale of the dinner, which is taxable. That's one, we're looking at similar transactions to that now, and we're waiting on some industry groups to get back to us with more information so we have a better understanding of how those events work. The two possibilities for tax would be tax on the charge that the person pays to attend the event and get dinner. The other possibility would be no tax on that charge, but the event, the entity putting on the event would owe tax on everything that it buys to put on the event.
Yeah.
So at the very least, it doesn't go untaxed. We're looking at some of the specifics, or waiting on some of the specifics to see what the best position is. A safe approach is always to tax the end sale, meaning what the guest pays for the dinner. And again, if we look at it as a sale of a dinner, they could buy the food for resale. It gets really messy if you look at it as, say it's a concert that someone pays to attend, and they get dinner included with it. The reason I say it gets messy is because the charge to attend a concert is taxable, and whoever puts on the concert also owes tax on everything that it buys to put on the event. So it's not crystal clear where that dinner falls in this mess, that the charge to attend the concert is taxable, but if that concert includes, say, a t-shirt, even though the charge to attend the concert is taxable, there is a position that the person putting on the concert has to also pay tax on the t-shirt that it buys, that it's not actually reselling the t-shirt, it's putting on a fun event, a concert, maybe some type of amusement park. You pay to attend and you get a t-shirt. So the amusement park owes tax on everything that it buys to put on its amusement park business.
Yeah.
And that might include items that it gives away. And so it gets a little messy because it doesn't seem completely fair to say they have to pay tax on the t-shirt that they buy and then also charge tax on the charge for admission. But that's why we're looking at these scenarios and trying to get more information from some of the industry groups to see what the best way is of handling this.
All right. So for everybody that's on the webinar, I hope that's as clear as mud for you right now. And not to again put you on the spot, but that's the best definition and some of the best clarity that I've got in a long time as far as who's supposed to pay for what in which scenario.
Well, and I think you just kind of highlight that at some point in this process, somebody needs to be accountable for that tax, whether it's you purchasing the good on the front end or reselling the good and someone purchasing on the back end. But
and at the moment, it really isn't clear. We put together a bulletin on fundraising a few years ago, and I was even just talking to Andrea Shepard. Some of you may have dealt with her over the years, about how at some point we need to rewrite the bulletin. There are some examples in there that we didn't do a great job of making it clear what point we were trying to make. There are some examples in there that I think we need to change the facts so that we don't send the wrong message. And I think if we can get it all sorted out, some of these fundraising event types of transactions should probably be addressed. Again, we know everyone, I think, agrees that the items, tangible personal property items that are part of these events will be subject to tax one way or the other. But it is clear as mud. Trying to nail down exactly, well, is this a charge for admission, which is taxable? is a charge for participation, which is taxable. And again, charges for admission and participation being taxable is only half the analysis, because the provider of the event still owes tax on everything it buys. Or is it a charge for a meal? Because a meal is tangible personal property, and if there's tax on a sale of the meal, that means the person that sells the meal can buy it for resale without paying tax on it. And so I agree with Tommy. It is clear as mud, and we're trying to get some clarification on the specifics of some of these events.
So to get us moving on down the line, I want to ask you one thing. So let's just say a community wanted to be very clear as far as to what they were supposed to do. Could they schedule a conference with you guys to get a letter of authorization? Or is it going to be more general when you guys come up with the...
No, you can, informally, you can always contact us and ask us questions. Information that we give by phone and email and presentations like this isn't officially binding on the department. The way to get a binding opinion is to write in for a letter ruling. And I don't know if I put it in here. We'll see. There's a regulation that runs through the basics on requesting a letter ruling. In short, you have to identify all the parties to the transaction, identify the transaction itself, what is being sold, how much is being charged, who's getting paid for what. We'd like to see invoices and contracts if those exist, and then we can give you a binding answer. Now, informally, depending on our time availability, we can meet with groups and try to talk through issues. We found that it's usually sometimes the smaller groups sometimes they don't have the time or the means to have meetings with us. It's, we may have an international contractor that does $1 billion of business a year come in and talk to us about how contractors are supposed to pay tax, because they have so much work going on in the state that they want to nail down exactly how it works. So it's usually bigger entities like that, but that's always a possibility depending on everyone's availability. Phone call, meeting in person for people that are local in the Atlanta area.
All right. Well, I'll stop asking questions and let you carry on with the presentation. And
okay, here you can see I gave the citation, Bulletin SUT 2013-03-28 on fundraising activities. I think we meaning the department, needs to tweak that and make it a little bit better, but there's some good information in there. And again, you can see the general rule: report sales using Form ST3, the sales tax return. You asked about sort of more of a one-off type event. So the form is FS, I don't know what that stands for, 32. It's a miscellaneous events form. So these would be for, generally speaking, maybe smaller entities or organizations that just have one-off sales on an irregular basis, that they can report their sales and tax using that form, the FS32. I think I have a few slides here touching on which nonprofits have exemptions for their sales. And again, I know I'm being repetitive, but the general rule is that sales by nonprofits are subject to tax unless the General Assembly, the Georgia Legislature, has specifically provided otherwise. So the Boy Scouts and Girl Scouts do not charge tax on their food sales. Organizations with primary purpose of raising funds for books, materials, and programs for public libraries have an exemption on their sales. I believe they have an exemption on their purchases too. Parent-teacher organizations, public and private schools, when the proceeds go directly back to the school. Churches have a limited fundraising exemption. You can see under the top bullet point, churches and religious institutions. Under that, it says must be fundraising sales for certain charitable purposes for 30 or fewer days in a calendar year. I believe how we've interpreted that 30-day requirement is that the particular fundraising event must be less than 30 days. So, for example, if a church has a coffee shop that's open every Sunday, that's essentially the same event, and it's taking place more than 30 days in a year. it's carried on a regular basis, that would just be an example of taxable sales. But if a church decides to hold a book fair to raise money, and the book fair takes place over 7 days, that obviously is under 30 days, and those sales will be exempt. And then certain licensed child caring institutions and maternity homes, they have a similar 30-day limitation on their exempt fundraising sales. There's a new exemption that just went into place, I believe it might be July 1, 2017, maybe it was in May of 2017, for certain fine arts performances. It was kind of a convolutedly worded exemption, and we put out a bulletin. I'm not sure if the bulletin truly clarifies things, so that might be an area. If that applies to anyone, let us know, and we can try to work through it with you. Rock Eagle 4-H Center has an exemption on its sales. And as I mentioned before, that for entities that are selling goods, they can buy those items tax-free for resale by using Form ST-5. And that gives our website for obtaining some of the applications for certain exemptions. And I believe the bottom bullet point that's directions for how to find some of these applications on the website. I think there's a link at the top for forms, and then you can go under sales and use tax, and then certificates of exemption. When a donor gives tangible personal property to a nonprofit organization, the general rule is that the donor is responsible for tax on that. In many cases, it's an item where the donor has already paid tax when they bought it, and so it's not really an issue. But the point here is that giving something away is actually a taxable use. So if I buy clothing to give to a nonprofit entity, even though I'm buying it for the purpose of giving away, and more specifically, giving away to a nonprofit, my purchase of those items is still taxable. Giving items away doesn't make the purchase non-taxable. And in fact, if I somehow did not pay tax on the purchase of that clothing, when I give it away, as I mentioned, giving something away is a taxable use, I would then owe tax on that use of the item, with again, the use being giving it away to someone else. In the third bullet point, it reiterates the rule that if donated items are sold by a nonprofit, the nonprofit must collect tax on those sales. The nonprofit does not owe tax on its receipt of donated items. So if I give clothing to a nonprofit, that's a non-event for the nonprofit. That's just them receiving a gift, a donation. There's no sales tax to that. And I think we've talked about the items on this slide. These are when a nonprofit gives tangible personal property to a donor in appreciation for the donor's gift. And again, the general rule is the nonprofit is liable for tax on that item that it gives away. And some of these bullet points talk about record keeping, and those are really just the same record keeping requirements that apply to any business. When the department audits a business, the department is going to look for proof that that business paid tax on everything it's supposed to pay tax on, and or collected tax on everything that it should have collected tax on. So those aren't particular rules just for nonprofits. Those are just general rules for any purchaser and any seller in the state. And now for some of the resources, the department's website, dor.georgia.gov, and it lists some of the guidance you can find there. Tax forms, bulletins. I think those might be called policy bulletins now. In the past, we had policy statements and informational bulletins, I think. We now just call them policy bulletins. We publish letter rulings online. If anyone's thinking about obtaining a letter ruling, just so you know, the letter rulings are all redacted before we publish them. We remove all the information that could identify the taxpayer, and we send it to the taxpayer to review before we publish it. The Georgia Tax Center is the online portal for filing returns and paying tax. It's gtc.dor.ga.gov, and as it mentions, you can register online, file your returns, make payments, look up sales tax numbers. The email address there for getting help from the GTC, I found that group to be very helpful. Sometimes I receive questions from people that are having account problems or some other type of problem with the Georgia Tax Center, finding something or using the site a certain way, and I forward their emails to that email address, and I found that they're very responsive and are much better at the online portal than I am. And so here's some click-through instructions. I believe rules and policies is somewhere along the top of the page. And then sales and use taxes, fees, and excise taxes is all one category. And if you click on that, you then get to some of the guidance. Statutes, that's the official code of Georgia. Regulations are written by the department. Policy bulletins, those are again written by the department. And letter rulings, which are written by the department to specific taxpayers based on those taxpayers' specific circumstances and transactions. Officially, letter rulings are not binding except with respect to the particular taxpayer that requested the ruling. However, they still give you a pretty good general idea of the department's positions on various issues. And this is a list of some of the regulations that are applicable to nonprofits. Chapter 560-12-2 contains, I believe, all of the substantive sales tax regulations. From there, the regs are on numerous topics, numerous types of transactions, nonprofits, service providers, certain types of items, certain industries, manufacturing, agriculture, for example. If you are near one of the regional offices, you can get good help in the regional offices. They deal with almost everything in a business life cycle, everything from registering the business to filing returns to collecting tax, paying tax, to filing a final return. They also will collect from taxpayers that have liens against them. They, like I said, they do a little bit of everything in the regional offices. And that link goes to a list of the regional offices. And I haven't been to that site in a while, but what it used to do is list each regional office, and underneath it, it would list the counties that are covered by that regional office. I think I just have a slide or two on what happens under audit. And I think I already mentioned that the audits division will look for taxpayers to be able to document everything, document their purchases, document their sales. In the world of nonprofits, I think they would look for documentation on which donations are tax deductible, which donations are not. The third bullet point lists some of the types of documents that an auditor would look for: records of purchases, sales, general ledger, sales journal, trial balance. They may look at a federal income tax return to compare the numbers to see if everything matches up with what we would expect to see in the world of sales tax. If you ever receive a notice of proposed assessment, you do get 30 days to request a conference with the Department of Revenue. Those conferences, generally speaking, are held with my group. And after the conference, we would regroup, research everything we need to research, and issue a ruling. If it ever goes to an official assessment, you then have 30 days to go to court. I think in the very beginning, I listed some of the functions of legal affairs and tax policy. That's the group I'm in. Oh, that must be it.
All right. So we're gonna take a few questions. Oh, we have a lot of questions. So we actually are about to conduct another meeting in this room. So we will take the questions you guys have submitted and try to get an answer back to you, if that's all right with Jessica, what you want to do.
Yeah, that's fine. I'm trying to see if there's anything like, you know. I mean, I think it's so, you know, from what we've heard today, it's always best practice to pay something, you know, rather than not pay something, or to at least, you know, reach out and have that conversation.
Yes, at the very least, and again, I know I've said it 100 times, that the purchases and sales don't fall under some type of blanket exemption just because it's a federally tax exempt entity. I see a note about banquets. I'm not going to jump into that too deep. I think that gets into some of the tricky scenarios.
Yes.
We would need some details. But if you want to forward,
yeah. So when we get questions,
we'll
if you guys could give detailed questions to me, and I'll get them over to Mitch. And so to answer Andrew's question at the bottom here, to get it clear, if you pay taxes on the purchase of T-shirts, then when you charge, if you sell them, you do not have to pay sales tax again once it's been paid once. Well, correctly?
I would say that's correct, but only in the right type of transaction. If you're selling the T-shirts, say as a fundraiser, those would be taxable sales, and you would actually buy the T-shirts tax-free for resale. So if you're giving the T-shirts away, say in appreciation for a donor's donation, then you would pay tax when you buy it. So it's not that it's not that what's presented there is wrong, but it depends on the specific transaction.
So if you guys could direct some specific questions to me, we will send those out. Thank you guys for participating.
Yep, thank you guys for being here, and we will get this uploaded to our YouTube channel.